Hi, and welcome to today's program. Today I got to sit down with Sears, one of the originators of the VIX. He actually coined the term the fear gauge to describe the VIX. And today's episode is sponsored by Guerrilla Trades, a new partner with the show. Please follow the link in the description to check out Guerrilla Trades. Every trader needs a good stock screener, and Guerrilla Trades is that and so much more. So let's not waste any more time, and let's get on with the interview. And this is my interview with Sears, which was recorded today. Enjoy.
David Lincoln Productions.
Information contained in this video is for educational purposes only. Everybody's financial situation is different, so some strategies covered in this video may not be appropriate for you. Trading in leverage products is risky and should only make up a small part of an overall investment strategy. To become a better trader, you need to take personal responsibility for any trading losses. Views of people being interviewed are not necessarily endorsed by this channel. We try to present many opposing views and let you decide. David is not a licensed financial advisor and is not trying to sell you anything. So sit back, relax, and enjoy the show.
Did you used to trade at the SIBO?
Yeah, I was a SIBO trader for 10 years.
What pit were you in?
I was working for Group 1, and I started out in Cisco, and then I was in Xilinx most of the time.
Yeah. Were you there with when Londrigan was there? Ben Londrigan?
Yeah. He wasn't like the head of Group 1 yet when I left. He was just like a regular trader, but I know that since then he became the head guy, and I'm still in contact with him. He's a cool dude.
He's a great guy.
Yeah.
And who was your VIX trader? Dominic.
Yeah, Dahmer, yeah. Yeah, he and I were very good. Yeah, he and I were together. We went through the training program together. He was my roommate in San Francisco with Group 1. He's obviously way smarter than me, though. He's way smarter than everybody, I think.
Yeah, I was just with him on a panel for the VIX's 25th anniversary. It was kind of an incredible story how Group 1 stepped forward to take the listing.
I actually don't know about that. Do you want to just talk about it for a second?
Yeah, it was incredible. You know, there was like a 10-year effort to turn spot VIX into something that was tradable. And so first, of course, they finally figured out you needed the ability to hedge the option, so they did the futures contract. But then when the allocation committee at CBOE put out VIX options, nobody wanted to trade it. But Dom had been involved in it from day one. So finally he raised his hand. Not really sure how to price it or anything else, but the rest is history.
Because almost every picture you see of like the VIX pit, he's like right in the center on his computer.
Yeah.
You can see him with his black jacket and his glasses and everything. He started with Group 1. He was doing these like deal arb trades upstairs, sort of like the opposite of your keep it simple type philosophy. He was always
totally
the expert in arbs and stuff. And so we would, if I didn't want to be on the floor for a little bit, he would say, okay, how much change do you have in your pocket? And he would take whatever change was in my pocket, and that was the price for laying on his couch for a few hours up in the office. So
that's hysterical. You know, as I recall, he has like a PhD in physics or something from Stanford.
Yeah, he went to Stanford. It was really intimidating for me starting out with Group 1 because there was him and there was a Yaley, and it was like, you know, super brain trust. But yeah, he's like, he's a super smart guy, and he's got like the glasses and everything to go with it. I've been actually trying to get in contact with him lately. I just added his wife to my friends list on Facebook, but I haven't been able to get him yet. So maybe he'll hear about me and reach out.
Yeah, he's a nice guy.
Cool. Well, I've done a little research on you. When I first I first started doing videos on this channel about 6 months ago, and your name kept coming up, and I looked, and I was like, oh wow, that guy's verified on Twitter. Wow, that's too fancy for my channel just starting out. But
even my kids are impressed by that.
Yeah, that's a big thing in this day and age, I suppose.
I guess, yeah.
So, so I was looking at some passive. You did a bunch of sort of press stuff when your book came out in, I guess, 2012, was it?
Yeah.
And then you stopped writing for Barron's. What was it, in February of this year?
Yeah, the end of February.
And what was that like? It's got to be a transition for you to not have the deadlines and everything in front of you.
Well, it's the deadlines are kind of a tyranny, as I think you know from doing your show. But it also helps you to sort of organize your mind and your life. And I spent so much of my adult life under deadline in one form or another that I miss it. But at the same time, for like the first 6-7 weeks, it was kind of liberating. But what's different in business, as you know, is that your deadline cycles are just different, and you might be running 20 at a time as opposed to just trying to meet your deadline for Barron's.
Is it true that you coined the term the fear gauge for the VIX? Was that your invention?
It is true.
Wow,
it is true.
That's amazing.
Then CBOE hated it too when I first brought it out. When the options market, which is so big now, really wasn't widely covered when I was a kid reporter. And I had this sort of deep fascination with what happened inside the market. And when I got hired at Dow Jones, my simple goal was, for the first year, was basically to understand what the newscaster meant at night on TV when he said the Dow Jones Industrial Average rose or fell by X points, and trying to answer that question sort of set me on this big pathway. And one day, the senior editor said to me, they said, Sears, we want you to cover the options markets. And I said, what is that? And they said, we don't know, but we think it's important. So I said, okay. And after covering it, because you might remember back in the late 90s, there were 4 exchanges. Yeah, I think New York was already shut 5 at the time. The New York Stock Exchange, the American Stock Exchange, the old Pacific Exchange, the CBOE, and the Philex, or the Philadelphia. And each of them had their own separate books. Like Dell only traded in Philly, IBM only traded, as I recall, at CBOE. Cisco was a big book for them too. And it occurred to me that what the options market needed was what the stock market had, which was a Dow Jones Industrial Average like instrument or index. So I sort of stumbled upon the VIX, and the CBOE hated it. They didn't like it being called the fear gauge, and it was sort of an inside joke at the time with some of the more senior traders. If a column in the journal ever began, the CBOE volatility index rose X% while stocks fell, it meant that nothing really happened in the marketplace. But now that's changed quite a lot over the past 20 years.
Yeah, I remember I left, what year was that around? I left the CBOE in around 2002, 2003, and at that point the VIX was basically, it was kind of like an indicator, you know. We knew that it kind of represented like this SPX, and it was way lower though than the volatility we were used to trading in individual names for like an earnings cycle or something like that. Totally. I remember it being at around like maybe 16 or 18 and being like, wow, really? The SPX trades at 18 vol? There must be like no meat on those bones, you know?
Yeah. That's true. I mean, all the action back then really was in the single names. But oftentimes, if you were trying to cover that market, there really weren't a lot of strategists around. People weren't saying, if you want to more smartly buy this stock or hedge this, do these types of trades. You really had to call around to each of the pits, and the pits, as you know, were so powerful back then. But it could be a pretty tedious process trying to find a needle, you know, in an options haystack, and the VIX just, the fear gauge just sort of overrode everything.
So how did that actually work to as far as a process of like getting the futures? Like, how did it work on a timeline of getting the futures started, and how did it work as far as liquidity? Because I know now if you go to the CBOE, where the OEX pit used to be is the VIX, and it's like front and center. But I know it was definitely a process for that to happen.
Well, I think it was 2004 when they brought out the VIX futures. And I remember having a decade's worth of conversation with various CBOE members, all trying to figure out how to monetize the fear gauge. Finally, I'm not sure exactly what the backstory is. I know Joe Levin, who ran research for the time at the CBOE, came upon the idea that they needed a futures contract to hedge it, and that Susquehanna stepped in to trade it. And I guess there's some market makers who are very quantitative, and there are others who are more comfortable being cowboy traders and just trying to live in between the bids and asks. A SIG is probably a blend of both of those approaches, and they stepped up and traded the futures, and the volume was really kind of slow. And then they went out and started to do a marketing or an educational visits. And what they found, and this is still largely true today, is that equity guys were pretty much unable to wrap their minds around the volatility curve. The people who really understood it were fixed income traders, and they were used to dealing, from the 2 to 30. But the equity guys couldn't figure out anything more than cash flow. So some of the first major users of VIX were fixed income guys, and even to this day, about 90% of all the flow in VIX options and futures is related to oftentimes to high yield traders laying off risk.
Well, that actually makes a lot of sense because they can kind of relate the term structure to the yield curve, I suppose.
That's right.
And yeah, Susquehanna was hugely respected by Group 1. I mean, we always thought of them as being really with it as far as their education and their understanding, and also just their coordination across many platforms. The process of multi-listing everything, you were talking about that a little bit earlier. Like Microsoft used to be in, like Group 1 came out of the P Coast in California, and we had it was called LMM, I think then, of Microsoft, which was the big one out there. And multiple listing was not a good thing for us market makers because it increase the competition. They would pair us off against each other. They go to New York first, and they say, what's your market? And then they come to us and say, well, New York's telling us this, and pretty soon the edge started to chip away. But it's a great thing for retail because
it is. That was my big story. Actually, when I was a young reporter, and I'd covered the stock market, and I remember asking somebody, why is it that these big blue chip stock options only trade at one exchange? And I can never get an answer. And I asked somebody at one of the big exchanges, and their response rather angrily was, "You can't force people to compete if it's not economically viable to compete." So I wrote that, and then the very next day, the Department of Justice's Antitrust Division launched an investigation that lasted, I think, 3.5 or 4 years. And at the end of it, of course, the exchanges were forced to settle, and it changed the entire regulatory structure of the market. And to your point on spreads, I recall the SEC did a study, and I think that the spreads came in something like 75, 80%.
Well, also at the same time, we went to decimalization. So, when I first started trading as a clerk to try to get into the trader trainee program, we would do fractions. We'd bring fractions tables home over the weekend and try to subtract as quickly as possible 9/16 minus 3/8, and do the math in fractions so that we could be the first one to make a market on something. And decimalization was another thing that kind of chipped away at the
penny wide,
the bid-ask spread. Yeah, and it comes down to the market is going to bear a certain amount of liquidity where people can make money, but it was certainly there was more edge for the people on the floor back then, and there was definitely they could definitely tighten it up and somebody still stay in business,
which is not the case anymore. I mean the liquidity is not that great, and I wouldn't be surprised if 90% of every option class traded in some type of quote relief.
Well, back then we had, we could declare a fast market, it was called, and that meant that, we got
You're dating yourself with that phrase.
Yes. Yeah. And actually, my particular job is pretty much gone, the market maker on the floor job, because now a market maker would cover 400 different issues using computer programs.
Yeah.
And some options really are tight, and I'm just amazed by what good fills I can get as a retail customer now by going mid-market on things, and it seems like there's pockets of liquidity, which is great.
When you can catch them, I mean,
Yeah.
I've been frustrated at times just on my gigantic 5 and 10 lot trades, where I can't get I get a decent fill, but you have to know to trade mid-market. You have to know to set the limit, and even then, you don't always get filled all at once, which I think is kind of bonkers.
Yeah, I guess it comes down to sort of knowing your products and just testing the waters. A lot of times when there's like a number coming out at, say, like 10 o'clock in the morning or something, they'll widen stuff way out, but there's definitely an inside market, and people will kind of spoof it where, like, if they want to buy stuff, they'll put like one lot offers in to tighten up the market.
Yeah,
And there's all these games that people play.
A lot of games.
As always. I just wanted to ask you, so you pretty much called the Volpocalypse in your article, which is another very impressive thing.
Thanks.
A lot of people were saying, well, it's a low thing, but you nailed it. What sort of gave it away for you?
Well, just very simply, watching Vol and watching VIX and putting things together, and then watching the fascination in the retail sector, well, not sector, with individual investors who were trying to get rich or die trying, shorting the VIX. And then I started hearing about it from a couple of really smart guys, and I looked into it, and then I saw this sort of, I liken it to like a limpet mine along the hull of a ship, where all these guys were just all these retail products, the XIV and others were lined up, and they had taken on too much. They were just too big, quite frankly, for the market. And if something happened, they're going to be forced to chase. And when you see those types of structural issues, they tend to be pretty significant. The timing of calling it, the timing is kind of difficult, but you just sort of watch it. And then as VIX started to get lower and lower, and last year, of course, was the least followed a year for the S&P 500 since 1965. It was just bonkers. And I think one of the lessons from the credit crisis, at least for me, is that if you have the cap, if you know what you're doing and you're confident in your thesis, and you've got the capital and you can marinate your position for a little bit of time, it generally tends to pay off. And I think that's exactly what happened in February. But it was really nothing more complicated than that. And of course, as a Barron's columnist, you have extraordinary access to people. And I did speak to some of the issuers of some of these ETFs. And this one fellow, I don't recall his name, but he launched into this like hour-long CFA level discussion as to why his ETF would never have one of these sort of termination events. And the way I didn't believe him, to tell you the truth. I thought he was just saying what he had to say. And the way you sort of handle that, journalistically at least, is you lay out your thesis and then you go, well, this is the risk, blah, 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 comma, but some disagree. And that's what I did. And of course, I never heard from those guys after Feb 5 or Feb 6.
Yeah, I was in the StockTwits group for UVXY, and a lot of people, blew out, for lack of a better term. And I got really lucky in that February 7th day around lunchtime, stuff started to go wacky, and I just was at a spot where, like, I don't understand what's happening right now at all. Like, I just felt this panic, and I just covered I was short some calls, and I just panicked and paid the offer and covered everything and got really lucky in that regard. But because all of a sudden it's like I just didn't get what was going on. I just had this feeling that but yeah, it was like, it seemed like free money all last summer. And
it was free money.
Yeah.
It was free money. It's funny, I got an email out of the blue from a guy who lived in our first apartment building. Like after we first got married, they were newlyweds too, and we'd meet each other on the sidewalk walking our dogs. He's an executive recruiter someplace in Manhattan, and he emailed me afterwards to ask me for my take on it, because he had lost like $350,000 on that trade, which hurts.
Yeah.
That's a lot of money to lose.
Well, congratulations on your
Thanks.
anniversary, by the way. That's awesome.
Thanks. Yeah.
Do you still save all your ones and fives when you do cash transactions? I saw an interview where you're saying you save your $5 bills
I
and
do
$1.
actually.
Wow.
I do.
That's amazing.
One holiday ago, a few holiday seasons ago, I took a bunch of coins to the Green Star, and dumped it. And I told my dad I had like $360, which we got an Amazon gift card for. And he says, that's not bad, but if you really want to make it interesting, save your ones. And so to try to teach the kids about money, and I have 3, I started saving singles, and then we take them to the bank and we swap them out for 100, and then we start saving 5s and 1s, and it adds up, and you never miss it. Yeah, I still do that actually.
That's a great.
I think the tellers at the bank think I'm a drug dealer or something.
Coming with all these ones and stuff.
Yeah.
That's awesome. Yeah. I was watching. I guess it was a podcast that I was listening to where you were talking about that. I had somebody ask me. I was listening to some of some excerpts from your book and stuff, and I had somebody contact me a couple of days ago, and I'm sure he'll forgive me for. I'm not going to mention his name, but I'm sure he'll forgive me for telling the story. But he told me, okay, well, this guy I know recommended this biotech stock. It's trading $3. And it has a price target of 27, and if I invest $5,000, I'll make $280,000 on this thing. And what do you think I should do?
Yeah.
And I said to him, "You're obviously not a trader, because no trader would ever say I'm going to make X amount on this and to the exact amount, 280,000 exactly." The way traders look at things is they look at their risk, period. And what you make is just kind of peripheral to how you manage your risk. And I really got that point from your book. And it seems like it was interesting because one of the guys you quoted in a recent article was from the StratiFi company. And I'm wondering if maybe that's how you got involved with them, but through him or something like that. But it seems like you're kind of practicing what you preach now and moving over to risk management as a second part of your career now.
I met this particular co-founder of StratiFi through another friend from the options market, and I spoke to the guy I quoted. His name is Ralph Dryborough, and I did quote Ralph. And Ralph's a really smart guy, and the more that we talked, the more we sort of realized that it made sense to collaborate. Leaving the Barron's column, not an easy decision, because I loved it. And I especially loved the community and who I wrote for. It had the strongest sense. I always said I had the smartest readers, and I really believe that. But at StratiFi, it's very much in startup. And I sort of think that one of the great lessons from the 2008 credit crisis is that people are really attuned to volatility and risk management. And there are all these huge demographic forces that are at work that are sort of driving that point home. And so I wanted to jump and get involved in this fintech stuff because it seems incredibly exciting. I worked for some exchanges too, like after the grandfathered options story and the settlements. I went to work at the Philadelphia Stock Exchange as a senior advisor to the chairman, and helped with the demutualization of that exchange, and we had everything reported into me and this one other guy. And then I went to the International Securities Exchange, which introduced electronic trading. And about a year after the IPO, I left and came back to journalism. Well, I say that as background because I sort of feel that right now there's a similar sort of zeitgeist moment going on, where the options market, which has sort of been where a lot of really smart traders and investors hang out, is now going mainstream. And I think that the StratiFi will enable me to sort of become more directly involved in that in a way that can be really impactful.
Yeah, just to catch viewers up if they don't know about it, the ICE was a electronic marketplace that came on to compete with those 5 original sort of exchanges, and so you're involved heavily in that, huh? We didn't like the ice
I
very
was.
much as market makers on the
Nobody
floor.
did. Nobody did. I came on board with the title of basically the director of special projects, and I wound up doing a lot of analysis of competitors.
There was like Timber Hill was doing a lot of stuff back then too to kind of tighten the markets. Yeah.
Well, Thomas Petterfy, who I saw recently actually, I've learned so much from him about how markets operate or should operate, and Thomas started the box because he had his own idea. I think it's the Boston Options Exchange. And I don't think it's ever been bigger than 5%. But at one time, the International Securities Exchange, it was the biggest. It dominated the market. There were six. No, I guess five, because CBOE bought the New York business. And by the second or third year, I think the ISE had 32% market share, which is huge. But of course, and now I think there are like 16 exchanges, and you can do anything you want to with an option. There are too many exchanges, I think. But but this whole risk management area, I think, is pretty exciting. And I think a lot of the things that we all take for granted in the options market are revolutionary outside of the options market. And the chance to sort of explain some of these things to people and sort of show them how they do it with how it can be done with technology, to me, is just so exciting.
Well, walk me through it just a little bit. I have requested to demo some of the software, but I haven't done that yet. A lot of times I'll go to these big financial firms and I'll request to demo something, and they'll be like, "Oh, you're a wealthy investor, blah blah blah," and they'll be ready to call me and how much money do you want to put in? And then they'll find I'm from the media, and it takes me a little bit longer. But as far as I know right now, you can sort of upload a portfolio to the website, and they will analyze it for you and give it various numerical ratings. Is that?
So a way to think about this is what BlackRock has done for institutional investors with Aladdin, we're trying to do for individual investors via their advisors. So initially, we're going after financial advisors, and we're giving them basically a risk management app that lives on their desk. And it works this way: the advisor would upload the client portfolio, and we then analyze for 4 key risk factors: volatility, correlation, tail risk, concentrated stock risk. It spits out a number from 1 to 10, with 10 being the riskiest, and then it comes up with some suggestions for I don't want to be jargony, for lowering the risk. And
that's very interesting. Yeah, those 4 categories are very interesting. I'm sorry to interrupt. Continue.
And so these things, which are so common, like we talk about vol and correlation risk all the time, or we look at single stock risk and then try to lay off the risk or control it, are really not that commonly considered amongst individual investors. Even at the highest, even at high net worth, these are not things that are normally done. And so sort of that's kind of what we're trying to do, and trying to explain it. In my book, I came up with this thing I call the good investor rule, which is that, and I learned it in the options market. It says bad investors think of ways to make money. Good investors think of ways to not lose money. And I think the StratiFi Prism technology, and this is what really attracted me to it, kind of expresses that in a technological format.
Can you explain to me for a second about what you just mentioned about BlackRock, what their technology was? Because I don't really know anything about that. I was shaking my head, but I don't know what it is. Yeah.
So I don't think it's an overstatement to say that one of BlackRock's secret sauces, one of the reasons why they've managed to amass $6 trillion in assets, is that they have this gigantic computer system called Aladdin, and it's a risk management system. And like even during the darkest days of the credit crisis, the Aladdin system was used by many asset managers and even governments to try to figure out the risk on their books. Because when most people think, well, I own Apple and I own JP Morgan and I own the SPY ETF and my account value is X, and they're like that fellow you mentioned earlier, I'm going to spend, $5,000 and I'll make $270,000 if all these things happen and the price targets. Somebody trained from an options background thinks that's completely insane. You're risking $5,000 on WAD and watch the vol and what are the event risk and all these and the interest rates and all these other things. Well, Aladdin basically does it. It basically you load up a big portfolio, and as I understand it, and this is an oversimplification. It basically looks at 18 million factors and comes out with some sort of risk score. Now the sort of the genesis behind it is that when Larry Fink, the CEO of BlackRock, was a young fixed income trader at the predecessor to Credit Suisse. I don't recall the name of it. Maybe CS First Boston. Maybe.
Okay.
He had a bad trade and he lost and he got fired, and that sort of ignited in him this very deep sort of risk management discipline, which they then captured in Aladdin. And tons of people use it, and it's very sophisticated. But our StratiFi Prism technology is just, it's simple. It's much simpler because what are the key risks? They're going to be volatility, correlation, which is really just diversification, getting black swan, or if you own too much stock. Like one story, there's a certain fellow I know at one point who owned shares in a company called Metarex. They were a cancer biotech company.
Okay.
Not a derivatives guy by profession, and he owned it. And at one point, it was worth $22 million. And everybody said to this guy, "You've got to hedge this thing. You've got to sell it. You've got to override it. Buy puts on it. Sell it." And he was so in love with his position that he was still hugging it when it fell to like $2 a share.
Yeah.
And that's happened to so many people. And now I think you got these giant demographic trends where people are retiring and they're living longer, and medical expenses are a risk factor for them, and they're afraid to lose money, and they can't really own fixed income because fixed income might be one of the riskier investments around, and also doesn't pay that much. So they're forced to take on farther and farther out on the risk curve, even at a time in their lives when they should not be so reliant. And so I think if we can sort of capture this, like Aladdin does and our Prism does, it can change the pathway, because everyone trades differently, as you know, even on the floor of the CBOE. But the one thing everybody has in common is nobody loses big, and they manage that downside because they understand it. And that's what I'm hoping we can be successful at.
Yeah, I think that it would probably be a very common thing where people would have like investments that are like duplicate investments where they're putting all their eggs in one basket, but they don't really realize it, because people have like careers these days where they'll jump from spot to spot, and they might have like a 401k from here and one from here, and if they just kind of left whatever the default was, they might end up having these big concentrations that they're not aware of.
They're not. And even if you take like the basic 60-40, 60% of your portfolio is in stocks, 40% in bonds, those things, everything goes to one. Or if you get some sort of big concentrated risk event, correlation increases, and bonds behave like stocks and stocks behave like bonds, and there's no shelter from the storm. Now, of course, you can't. It's silly to hedge out all the risk in a portfolio because you need it to animate the portfolio, but you should define it, and a lot of people don't even understand it.
So how do you guys get paid for this service? Is it a subscription type service, or is it a percentage of? I guess it would be a percentage.
The way we do it is it's basically like a SaaS business, software as a service. So we have monthly subscription fees. Okay. And so we do it for the size of the brokerage office. So you have this many people or this many seats. It's this number, and we try to do it low. But that's basically how it's done.
So it's sort of like a consulting pay structure where you're like you make a deal with a specific company for how many people they have.
Yeah, I think it's how Bloomberg does. It's how Bloomberg is paid. It's how a lot of technology companies are paid, and it just sort of brings that sort of that sort of West Coast panache into onto Wall Street. It's an easier. I think it's an easier, cleaner way to do it.
So your responsibilities are you sort of like are you going to be a sort of like an ambassador for them, like doing a lot of marketing type stuff, or how does that work?
Yeah, I think my official StratiFi technology is chief market strategist.
Okay.
Chief market strategist, which basically means that I get to talk about the things that I love, the investing and risk, and all of those things.
Nice.
It's I get to meet with investors. I get to hear their stories. I get to walk them through what we do, and then discuss with them ways to redefine the risk in their portfolios, which I think is pretty cool.
Yeah, it sounds like fun. Are you going to keep your? Are you still going to do a little writing here and there? Do you think?
Yeah, totally.
Yeah.
In the next couple of within the next couple of weeks, I'm planning to announce a new website that's going to be associated with StratiFi, where I'm going to take all the things that I covered in Barron's for the striking price, but do it at a different, at an even bigger level, to tell you the truth. So I'm pretty excited about. Look, I think these are the types of things that people need to hear about one-to-one. They need to hear about them in these forums, and they need to read about them too. And the more that we can do this and increase the investor education, then I think the better it can be. And aside from that, I really like to write, and it's fun for me.
Well,
I like that.
I mean, the environment's changing so much for financial media these days. I mean, I just have a very small channel, and yet I'm finding myself on like 10 different platforms. I just list like, LinkedIn, Seeking Alpha, Trading Talk, or something like that. Facebook, YouTube, and everything is sort of it's really changing. Did you notice? Do you think Barron's is going to survive in printed form? Did you notice? Was it like how was it doing when you left? Was it like I don't know.
I mean, Barron's is a very singular publication. It is of all the publications in America, our reader demographics are the highest, which is to say, the largest net worth. I think it was like the average Barron's reader has like a liquid net worth of like 1.2 or 1.4 million.
Wow.
And the journal was something like 600,000. So the way I always describe Barron's is, and those numbers may be a little off, but they sort of illustrate the point. I always thought Barron's was the 1% of the Wall Street Journal's readership. And the difference between Barron's and the Wall Street Journal is, in my mind, and this is what I would tell people when I was there, is that Barron's will tell you what will happen, and the Journal will tell you what happened and maybe why it happened. And so as long as Barron's is able to sort of exist within that pretty demanding slice of the market, it'll do just fine. But I would be stunned if the print publication exists within a decade.
Yeah.
Which is only because of the way things are changing. I suspect you're going to see a massive push towards digital, and the website barrons.com is already one of the biggest. Well, I know in America, but perhaps even in the world, which is saying something. And then of course there are conferences and there's videos and stuff like that. So I think it'll survive. But what intrigued me so much and still intrigues me is I can meet somebody like you who's got this really deep expert level knowledge, and here you are with your own show operating on all these different platforms, and you have a following, and you can discuss things for an hour or more at a level that just defies mass journalism. And I think that's huge, and I think that's going to continue to be really big. And frankly, that's what I'm hoping to tap into with this new media site that I'm going to launch in a couple of weeks.
It's very hard to. I think it's very hard to sort through so much that's out there on the internet these days. Like it's hard to find. There's so many niches, and there's so much junk out there. So it's hard to. I mean, traditionally it seems like online the stuff to do with the markets has been taking advantage of naive people, whether it be like, okay,
100% agree.
Gurus, stock signals, and this sort of thing. Either that or doom and gloom, the guys who are saying that it's going to crash tomorrow. Like, if I bring in a video that says the market's going to crash tomorrow, I'll have 5 times as many views as saying, well, the market's probably going to go slowly up, because people love this conspiracy stuff, and it's craziness.
Like speaking of that, I got blocked by Zero Hedge. So, I mean, those guys are always painting an apocalyptic.
Congratulations.
Thank you very much.
I hope to get blocked by them soon.
Thank you. They have very thin skin. Like I noticed that, and I think that's the real. And I think that the investors are really smart about that. I think there's going to be a permanent group of people who are naturally going to go down that sort of doom and gloom path, and they're attracted to it. But I think there's an even larger group of people who recognize it as being a bit of show business. And I know, like when I was at Barron's, and this is still true today, if you want to attract readers, you can say the sky is going to fall. And you see this a lot with VIX, frankly. People will say, there's a big VIX trade, somebody's buying out of the money, VIX calls, he's preparing for the market to collapse. Complete crap most of the time. They had that, somebody even created that 50-cent trader. Do you remember that?
Yeah. Yep.
I mean, all that guy was doing was hedging a high yield debt portfolio, but somebody made him into a media celebrity. And I think they get a lot of attention that way. But I think investors are really smart, and they identify places where they get good value and good information and come away smarter.
Yeah, I mean, options is easy to get confused with because a big print goes up, and you got to figure out if the customer's a buyer or a seller, what they're doing, whether they're closing or opening, and just those few bits of stuff that are public get confused. Not to mention whether keeping track of what they're doing and why they're doing it. It definitely is. I understand why retail gets confused on that stuff. I wanted to ask you, which I usually ask most people that come on here, but it's getting to be a little bit easier to answer than it was 6 months ago. But what's your take on Bitcoin? And is this the next SIBO product that's going to be in taking over the OEX? What used to be the OEX in 10 years? Will VIX go to the wayside and Bitcoin takes over? Well,
about a year ago or more, when it was trading about $250 per coin, I heard about it so much, I tried to look into it. I thought I'll just buy $5,000 or $10,000 worth, and I couldn't figure out a way to do it that made me comfortable. It was like you mentioned earlier, like you couldn't figure out the pricing mechanism, so you were gone. I couldn't figure it out, and so I didn't do it and missed out. I've heard the Winklevi, who are working with CBOE, speak about Bitcoin, and they paint a very compelling narrative. That said, every time I hear Bitcoin, I think of that great book from the 1700s, Extraordinary Popular Delusions and the Madness of Crowds. Because if you spend any time, and it's kind of a fun experiment. I've got some Bitcoin people who I follow on Twitter, and even a former colleague, a guy named Michael Casey, left the Journal and now is at CoinDesk, where he's the chairman. So I imagine there's something to this Bitcoin stuff. But maybe not as much as everybody thinks. I don't think it's going to go away. And I'll tell you today, I was speaking to a derivative strategist at one of the big banks, and he said something to the effect of maybe we need to look more into blockchain, which is the technology that powers it. I don't know. What do you think? You think that Bitcoin is the real deal?
My view is not very popular, but I think it topped out in December of this year, and the craziness, and it's just going to go nowhere from now on. I'm predicting it's never going to get above 15,000 again, but I think blockchain is a compelling technology, like everybody says, but the people who are saying that, they're saying that because they want to get rich quick, and they think that they can buy a Bitcoin, they'll make $1 zillion, and they'll sell it out. They're not saying, like, I'm interested in the technology, because they're actually interested in the technology, because there's 5,000 other technologies you could be interested in. And these guys who are like
it's like reading Playboy for the articles as a kid.
Right. There's these guys, 20-somethings who play video games all day and have no job, are not interested in innovations in technology. They're trying to make something for nothing, like people have been trying to do since the beginning of time. And I missed the boat too. I had two friends at a side job who bought Bitcoin for $3,000 and sold it for $10,000, and they were trying to get me to do it the whole time, and I wouldn't do it. And
Do they do it in size?
No, I mean they bought one or two of them, but for them it was size because they weren't rich people or anything, and they it was a big part of their savings, and because it was this kind of like cool secret thing for a little while, but yeah,
I think the Bitcoin culture is really fascinating.
Yeah,
and in terms of like the people who seem to be very vocal about it tend to be millennials. They tend to be very disenfranchised with the system. They tend to be sort of, they want a new world order in many ways. They sort of see Bitcoin as their sort of the internet's currency. It's quite interesting to me.
Well, these guys, like, you couldn't for YouTube, it was a huge thing on YouTube for a while, but you couldn't say anything
How so?
negative.
What were they doing?
I just mean that, like, if you got a channel that had anything to do with these coins, it would explode. I mean, you could get 200,000 viewers, but they had this thing called fuddle or something like that, which means like anything you can't say anything negative about it, no matter what, or you're thrown out.
Hodl.
Oh, and hodl is like hold.
I
like,
love that phrase.
Yeah. And
hold on for dear life.
You're true. You're right in the fact that it was this whole culture that was really interesting and kind of like sort of positive about the future and there was this crazy excitement going on, but I think that it kind of ended in December when things topped out. So, prove me wrong. I've been wrong all the way up, so they can prove me wrong. But it's going to take people wanting to pay above that 15,000 to get more Bitcoins for it to go higher, obviously, in most simple terms.
I mean, when CBOE listed it or announced the listing of it, I was still at Barron's, and I thought it was so out of character for the exchange. And I'd been bullish on the stock since the IPO in 2010 at 29 that I said, like, to me, it seemed something was off. And at that point, we backed away from CBOE stock, which is around maybe like 130, 136 at the time. And I just saw today the thing dropped down to like 98.
Wow.
Not just on Bitcoin. I mean, the VIX complex is not as robust as some of the analysts would like. Yeah,
that hit in with XIV and all that in February really, short VIX already had a bad name, but that made it worse, I think.
Yeah, I think so too. I think you're right.
Which is unfortunate. But things roll on, and the VIX right now, it's been up the last few days, but we're in kind of a mid-range now. It's in the 15s, I suppose. And it just seems like, I mean, it's a truism to say it's fairly priced, because it's the market and it's fairly priced. But we're kind of in a mid-range right now, and we'll just have to see what happens. Somebody was asking me what to do today, and I don't give people advice, but I just said when things are in a mid-range, you don't get big on either side. So
I had a lot of my friends who been senior traders or work or still work as strategists and have seen a couple of market cycles. Their view is that this is just a normal vol environment. We're back at it, and people haven't really seen it for a very long time because things have been so suppressed by the Fed. I don't know. I like to think that what Oscar Wilde said will hold true, which is burnt children love the fire, and something will happen and they'll come back to it. And I think like the early February, I heard somebody call it the Holocaust, which I thought was kind of clever. It's all structural and evolutionary, and the market will work itself out. And in 10 years, people will have sort of forgotten about this, but it'll be a footnote in academia.
Yeah, exactly. Well, listen, I want to let you get on to your celebration today, and I do appreciate you making time for me because
I had fun.
It's that stuff about the beginnings of the VIX and stuff is really interesting. So thanks so much for sharing that with me. And I'll stay in touch with you because I want to see how things develop for you moving forward, and I definitely want to follow your blog, and we'll send people there from here.
Thanks. Look, I'll announce it on Twitter, and my handle on Twitter is SM_Sears, SEARS.
Okay.
And I'm active. I love the conversation on that. So thank you. Now I have a question for you.
Yep.
Are you really related to Abraham Lincoln?
Yes, I am. It's through my my mother's family, and she we went back and found some paperwork on it because I was like quizzing her on it. But I'm sure a lot of people are, but I'm one of them. Yeah.
That's really cool.
Yeah.
Do you have any sort of Lincolnia, as it were, at the house? The president?
We've got like old newspapers and stuff. We've got a bunch of stuff from the Civil War also, but it's something that I've always been proud of in a way, although I have no control over it. You know what I mean?
That's pretty cool.
Yeah.
Do you know the Abraham Lincoln Bookshop in Chicago?
No, I don't know that.
All right. It's 357 West Jackson Street. It was founded by Carl Sandburg and a couple of his buddies.
Oh, wow.
I want to say in the 40s. I could be wrong. A guy named Daniel Weinberger owns it now. It's one of the, you'll love going in there, especially with your connection to the president. But it's also like once you start buying books from that guy, you're gonna need Bitcoin to cover the bill. But it's a fascinating place, and I think you might like it.
Oh, nice. We'll have to check that out.
All right.
Cool. All right. Well, listen, thanks for coming on, and thanks everybody for watching, and we'll see you next time on the David Lincoln Show. Bye now.
Thanks, everybody. I really enjoyed it.
All right.
Take care.
Bud. Take care.
Bye.
All right. I'll click off right there. Cool.
All right.
Thanks so much for doing this, and fascinating stuff. And I am gonna order your book and read it because I do want to check it out. I didn't have time to read it yet, but
Thank you.
sounds like good stuff. And thanks for your time, and I will talk to you soon.
All right. Good luck with your show. I enjoyed it.
Oh, great. Thanks for coming
All
on.
right.
All right.
Take care, man. Bye.
Bye.